Welcome to the presentation of Santos' 2024 half-year results. I'm speaking today from the traditional lands of the Kaurna people of Adelaide Plains. I pay my respects to their elders past, present and emerging. I'd also like to acknowledge and recognise the support of traditional owners, Indigenous people and nationals everywhere Santos operates, including in Papua New Guinea, Timor-Leste and Alaska. I'm pleased to present yet another set of financial results that demonstrates the success of our disciplined operating model and our strategy. Santos continues to generate strong cash flows from existing assets and has made significant progress on its major projects, Barossa, Pikka and Mumba carbon capture and storage. These projects will underpin long-term stable production and cash flows for the company, with Barossa less than a year away from startup and Pikka following close behind. Mumba CCS will start up this year, generating a new revenue source from carbon credits. I will provide an overview of the half-year results for 2024 before handing over to Chief Financial Officer Anthea McKinnell, who will discuss them in more detail. Before we start, I draw your attention to the usual disclaimer. Sales revenue of $2.7 billion for the half generated EBITDAX of $1.8 billion, free cash flow from operations of $1.1 billion, and an underlying profit of $654 million. I am pleased to report that the board has determined to pay a dividend of $422 million, or 13 US cents per share unfranked. This is a record interim dividend for Santos. Our free cash from operations in the first half of 2024 is consistent with the half of 2023 at almost $1.1 billion. This has enabled a record $422 million to be returned to shareholders, achieving our goal of returning at least 40% free cash flow from operations to our shareholders. This reflects our commitment to deliver consistent, reliable shareholder returns in accordance with a capital management framework. Always safe is one of our core values. Our expectation is that every day, every Santos employee and contractor is focused on keeping themselves and their workmates safe so that everyone goes home healthy every single day. Personal safety performance improved in the first half, and we've seen a significant reduction in loss of containment incidents. While Santos compares favourably with industry benchmarks, process safety performance is critical, and continuous learning from all safety incidents is vital to improve performance and create safer workplaces. Our operational performance has been strong for the first half of the year, in the face of a number of external challenges and uncertainties, from extreme weather events to inflation. I remain focused on the things within our control, in particular, managing our cost base. My management team shares this commitment, and we have initiatives in place across the business to continue to drive costs down. At Mumba, the granite wash horizontal well encountered a 900-metre lateral section in the target interval. And pleasingly, the well has confirmed the rate per stage we can expect in future development wells, which should deliver in the order of 10 to 15 times the productivity of vertical wells. We successfully installed and commissioned solar and battery systems at 2 of our camps in the Cooper Basin, advancing our plans for electrification of operations. Santos plans to grow production with continued development in the central area focused on the Granite Wash play, followed by the Patchawarra Deep. We continue to improve operational and cost performance with drilling technology advances, multi-well pads and campaign drilling combined with rationalisation of surface facilities and midstream optimisation through electrification, simplification of processing and other projects. At GLNG, we delivered record production rates from our CSG fields, and we remain on track to deliver 6 million tonnes of LNG from the project this year. GLNG also continued to support East Coast domestic gas markets through seasonal shaping of our LNG cargoes to make more domestic gas available during the East Coast winter demand period. Across the operated facilities in PNG, we achieved record reliability of 97.5% in the first half, delivering higher production. Both Angore wells were drilled and completed, with Angore on track for production in the fourth quarter of this year. Our infill drilling program in PNG has also been very successful, with the discovery of high-quality, producible oil zones in deeper reservoirs. 7 equity PNG LNG cargoes were sold, delivering incremental value for shareholders, and our marketing and trading teams completed 2 price reviews with long-term customers in PNG. And in Timor-Leste, in Northern Australia, Bayu-Undan continues to exceed expectations and is still supplying gas into the Northern Territory domestic market. Over in Western Australia, cyclical production from the Reindeer field is expected to continue throughout the second half of 2024. And the WA team is also progressing our decommissioning campaign safely, effectively, and efficiently, with a focus on continuous improvement and optimized scheduling to manage costs. Santos Energy Solutions continues to develop our 3-hub CCS and low-carbon fuel strategy in Australia and Timor-Leste. Mumba CCS is in the final stages of commissioning, with the pipeline being pressured up and CO2 being introduced to the system imminently. The project is on track for first injection and ramp up to full capacity by the end of this year. We're now planning phase 2 of Mumba CCS and have completed a study on CCS pipelines for the project. The Cooper Basin is a very exciting long-life asset to have in the portfolio because of its key infrastructure position, its connection to Gladstone LNG and export markets, and its gas production growth potential, as well as its carbon capture and storage and renewables resource potential. Together, these factors could make the Cooper Basin an energy super basin for another 50 years or more, producing both traditional and low carbon fuels and sequestering carbon at scale. With first gas from Barossa expected next year, I want to take a moment to highlight the strategic importance of LNG in the energy transition and how Santos is expanding its LNG production to meet regional demand. Energy security and the energy transition will continue to drive demand for LNG in Asia out to 2050 and beyond. Santos has a portfolio of world-class LNG assets and development projects that by 2028 will have a capacity of nearly 8 million tonnes per annum of LNG and increasing production for delivery into Asia. The portfolio is advantaged by a quality customer base and strong contracted pricing with an average slope to oil above 14%. Barossa will add around 1.8 million tonnes per annum to existing production of LNG from PNG LNG and Gladstone LNG. The proximity of Santos' LNG portfolio to Asian markets is a real advantage over other supply sources, with lower shipping times and cost and lower shipping emissions. Santos' long-term contracted positions with high-quality LNG buyers in Asia provide stable cash flow generation. The Barossa gas project is now almost 80% complete, and the progress we have achieved following the successful court case earlier this year has been impressive. Since drilling recommenced in January, we have drilled and completed 2 wells, with a 3rd well drilled to the top of the reservoir. The most recent well results were better than expected, with excellent reservoir quality and thickness encountered. The gas export pipeline is now complete, with pre-commissioning completed in July. The SURF, or subsurface facilities installation, is on track and 75% complete, with the FPSO buoy installed and testing is now underway on the 6 infield subsea flow lines. The FPSO work in Singapore is on track, with all 16 topside modules now installed. The FPSO has been moved to the commissioning yard and is on track to sail away in the first quarter of 2025. I am very pleased with the good progress that we are making on Barossa, with line of sight to first gas within the next year. In Alaska, the Pikka Phase 1 project has progressed on all major work packages and completed a strong first winter season with 40 miles of pipeline installed, as well as all the vertical supports required to complete the pipeline. We have drilled 11 wells. The seawater treatment plant is progressing and other infrastructure to support production is on track. Mumba will be one of the largest and lowest cost CCS projects in the world and will be the proof point for the role carbon capture and storage will and must play for Santos, for Australia, and for our Australian and Asian customers. As I've already mentioned, the plant is now in the final stages of commissioning as we move towards first injection and ramp up to full capacity later this year. Importantly, the Mumba CCS Phase 1 project is set to generate a new source of revenue for Santos through the issuance of Australian carbon credit units. Mumba will be the first project of its kind to do so, and we expect to see revenue flow within the next 9 to 12 months after the Clean Energy Regulator assurance processes are completed. The market outlook for our products remains strong. While LNG supply and demand appears fairly balanced through to the early 2030s, a significant number of LNG projects will need to be sanctioned to fill the widening imbalance between supply and demand thereafter. According to Wood Mackenzie, gas demand in Asia is forecast to grow by 67% to 2035, with no peak LNG this side of 2050. As a leading global independent LNG supplier with advantaged LNG infrastructure close to Asian markets, Santos is well positioned to benefit from this ongoing demand. In oil, forecasts indicate there is a need for new supply investment even in the most aggressive transition scenarios, with projects such as Pikka in Alaska well positioned to meet ongoing demand. Santos continues to view Australia, the US, and PNG as critical energy producing nations for the world, underlining the importance of its investments in these regions. We continue to be unrelenting in sticking to our strategy to deliver long-term shareholder value through backfilling and sustaining our production, decarbonising our operations, and developing low-carbon fuels as customer demand evolves. In executing our strategy, we will remain disciplined in how we allocate capital, operate our business, and manage our costs. Santos is in good shape. The business is performing well. We have deep expertise and a strong team, and our focus is on delivering what we say we will do. You can see how our strategy has performed by looking at the free cash flow generation from our operations since 2015. By 2027, our free cash flow from operations target is around $4 billion, and by 2029, we could deliver almost $5 billion in free cash flow from our operations. As we deliver our major growth projects, our committed capex declines and our free cash flow yield looks extremely attractive over the coming years. This will provide us with optionality and flexibility to manage and deploy our capital. We have invested at the right time, and we now see opportunities to deliver significant returns to shareholders in accordance with our disciplined capital management framework. Our diversified and strong cash generative portfolio will continue to drive shareholder returns through the cycle. We are decarbonising our own operations with a target to reach net zero Scope 1 and 2 emissions by 2040, and we are embracing the opportunity to become a low carbon fuels company as market demand evolves. 2024 has been an exciting year for Santos so far. The base business is strong, and we have clear line of sight to new, stable, long-term production volumes generating robust cash flows from Barossa and Pikka from 2025 and 2026, respectively. We are excited by the progress that is being made on decarbonisation and the development of new earning streams from projects like Mumba CCS. I'll now hand over to Anthea to provide a detailed review of our financial results.
Thanks, Kevin, and thank you everyone for joining us. Santos has once again delivered strong financial results for the first half of the year. Our performance reflects our commitment to maintaining a disciplined, low-cost operating model throughout the business, as well as the advantages of our diversified portfolio. We continue to actively manage our cost base across all our assets, and pleasingly, with line of sight to start up at Barossa and Picar, we expect to see a reduction in the level of our committed capital expenditure from 2025. Driven by strong operational performance across the portfolio, we've again delivered a set of strong results, including free cash flow from operations of $1.1 billion and EBITDAX of $1.8 billion. We're maintaining a strong focus on our cost base, with unit production costs within current guidance at $7.94 a barrel, and we continue to focus on unit production costs over the second half of 2024. Our balance sheet is strong and gearing is within our target range at 19.9% excluding leases and 23.5% when included. Continued generation of strong cash flows has ensured we are well positioned to fund shareholder returns. We've delivered a 49% increase in the interim dividend to 13 cents per share unfranked. This is consistent with our policy at approximately 40% of free cash flow from operations for the first half. Santos' disciplined operating model and capital management framework are designed to support and drive our strategy, ensuring strong and sustainable cash flows. Our disciplined approach ensures we can continue to sustain production levels and carry out necessary maintenance activities regardless of fluctuations in commodity prices. Free cash flow generated above sustaining capital requirements is strategically deployed to deliver competitive returns to shareholders, maintain a robust balance sheet, and invest in major projects, including our critical energy transition initiatives. The combination of disciplined investment, cash flow management, and a strong focus on strategic priorities positions Santos to sustain long-term growth and deliver on our policy of distributing at least 40% of free cash flow from operations annually. As our major projects are delivered, our committed CapEx decreases and production increases, and we will actively balance the need to invest in the business and provide strong returns to shareholders. We continue to maintain a strong focus on cost management across our operations. Production costs have decreased slightly to $376 million compared to the same period last year, assisted by lower costs in Northern Australia as Bayu-Undan transitioned from LNG to domestic gas late last year. Unit production cost, excluding Bayu-Undan, of $7.94 per barrel, reflect higher production costs in the Cooper Basin due to increased maintenance costs, including following extreme weather events, as well as higher electricity costs in Queensland due to the use of 2 electric compressors, which have released additional gas for sale. For the second half of 2024, we expect to continue our strong focus on our production cost base. Our commitment to operational efficiency and resilience is further demonstrated by our full-year target of a free cash flow break-even oil price of less than $35 per barrel. For 2024, we're guiding a free cash flow sensitivity of around $400 million in free cash flow for every $10 increase in Brent pricing. We continue to actively manage and optimise the group's cost base and resources, both at the regional and the corporate level. For example, in WA, we have recently announced a reduction in headcount to better align our people costs with our work activities, and we continue to look for other opportunities to reduce costs across the group. Our diversified portfolio of upstream gas and liquids assets, supported by strong LNG contracts and inflation-linked fixed-price domestic gas agreements, underpinned an operating cash flow of $1.4 billion. This result is 12% lower than the first half of 2023, primarily due to lower volumes and lower realised pricing, partially offset by higher liquids prices. The average realised oil price increased by 4% compared to the previous half, while the average realised LNG price decreased 9%. Investing cash flow was lower compared to last year, primarily due to lower sustaining capital expenditure. And we delivered strong free cash flow from operations of $1.1 billion. Product sales revenue, though slightly lower than 2023 first half, remains strong at $2.7 billion. EBITDAX of $1.8 billion resulted in underlying earnings of $654 million for the half. This table provides a snapshot of our half-year results, showcasing the strong performance of our upstream gas and liquids business and its contributions to EBITDAX and margins. It underscores the strength of our diversified and balanced portfolio, which has delivered strong EBITDAX margins of 66% for the half across the portfolio. And we've maintained strong margins across all our regions. We remain focused on maintaining a strong balance sheet to ensure we are well positioned to execute our strategy. We continue to target a strong level of liquidity, with our total liquidity of approximately $4 billion held in a combination of cash and undrawn finance facilities. As previously noted, our gearing of 19.9%, excluding operating leases, 23.5% including leases, remains within our target range of 15% to 25%. We have secured transition finance for our share of the Mumba carbon capture and storage project. The facilities, with a 5-year tenor and totalling $150 million, will be used to cover project costs incurred to date and to draw upon as the project progresses to first injection and ramp up by year end. We have a supportive banking group with access to over $3 billion in cash, bilateral and syndicated loan facilities, most of which are undrawn. These facilities have maturities extending from 2024 to 2028. There is no substantial debt maturing before 2027. PNG LNG finance is repaid through project cash flows, with the final PNG LNG financing payment due in 2026. Our strong balance sheet and liquidity metrics are demonstrated by the stable investment grade ratings we maintain from all major rating agencies. Thank you very much, and I'll hand you back to Kevin.
Thanks, Anthea. In summary, we have started the year with a focus on disciplined operations in our base business and steady execution of our major projects. The company continues to perform well and has a strong pipeline of upstream production and new revenue streams from decarbonisation projects. We remain focused on operating our business efficiently and delivering our major projects to generate consistent, reliable, long-term value for our shareholders.